Bitches, yo. Hey, how you doing? Welcome back. It's Friday. And here's my good friend and co-host, Stout Monster Mean Motherfucker Ed Milewski.
Hey. 30-year U.S. yield at an all-time low.
Really? And tell us, Edward.
Debt spiral.
Debt or death spiral?
Both.
If you're a French Canadian, it would be the same thing. Eh? The debt spiral.
Hey, head.
That guy is in a debt spiral.
Head. What kind of spiral is it?
Head. What kind of spiral are we having today? Head. Jesus. Anyways, price of gold is on fire.
Yeah.
We're not even. Should we
Stock
not even
market.
talk about cannabis stocks today? Because cannabis stocks are sucking hind tit, as it were.
Yeah.
And
the runt sucks the hind tit, right?
sometimes
The litter, run to the litter gets
the runt sucks the hind tits, but sometimes
or maybe they don't even get the tit.
Sometimes the runt just gets the hoof right in the head.
Pow!
Damn. Take that, you little runt. All right, coming up on the show today, we got a really big show here today. Look, there's the street. Does it look cold out here? That's the street outside our window. That is Bay Street you're looking at right there. Charting man Dan from the Chart Guys is here, of course, to talk about the opportunities in the stock market from his point of view today.
Yeah, he must be having a hoot.
He must be. A very special guest today, Wolf Richter, who is the publisher of wolfstreet.com. Now, there are not
famous
too many people.
Famous guy.
He's a famous dude. There are not too many people who know more about what the Fed shenanigans are all about than this guy, and he can put them into simple layman's terms.
And wait, is he American?
He lives in, I believe it's San Francisco.
Right.
Yes. Another American is here today. Alan Brochstein joins us from Houston, Texas via Skype. He's got 420Investor, and he is the original chartered financial analyst in the United States to cover the cannabis sector. So his viewpoint is always interesting because it comes replete with the fullness of time.
Replete.
Replete.
I love that word.
Isn't that a good word?
It's almost like complete, but
yeah,
they tried to make it a little...
You know, our publishing partners advised me today that our audience basically is, we shouldn't speak in words that are above a grade 3 level. And I said to them, no.
Wait a minute.
Yeah, no. I said, wait a sec, you're confusing our audience with Ed. Because our audience is a sophisticated financial universe.
Thanks.
As I know, and you guys know yourselves.
Was that sort of a backhanded compliment?
Kind of. I'm using you as my comic foil today.
Foil.
Bruce Campbell joins us for the weekly Stonecastle Investment Management Cannabis Update. He's got some interesting things to say about the increased sales in cannabis compared to Colorado. He's got some interesting insight in that. And then last, but certainly not least, Lance Ippolito with the Future of Wealth is going to be here to tell us about his winning picks in the options market. So yes, here we are, just a fountain of profitable information for your dining and dancing pleasure today. Edward, what do we got? Show us a chart. Tell us what it says. I got to go to the bathroom.
All right. S&P 500. Look at this.
Wow.
Now
hey, click on that full featured chart little button there, will you? Yeah. There we go.
Now what do we got?
Well, you just wait. You're going to get
and
crosshairs. You're going to get real-time bars. Woo!
Yeah. No, we're taking on some air here.
Taking on some air?
No, wait a minute.
What does that mean?
Hair.
Some hair.
You know what? This coronavirus has slowed the world down, and yet the market keeps marching along, and now Apple warned, and now everybody's, wait a minute, maybe it's a little more dicey than we thought. And so a lot of people are starting to come out and say, Coca-Cola said some comments today.
Yeah. Well, so I'm actually in development on a large publishing project right now that is essentially looking at the long-term opportunities as a result of the coronavirus. Now, this might sound usurious to you, and you might think, my God, what a heartless bastard. He's using the people's misery to make money. Absolutely inexcusable. Anyways, since that's what we're doing here, we've identified a bunch of stocks that are going to go through the roof pretty much.
Did you see the Virgin Galactic? What's the space company by that Sir Charles
Manson?
Branson?
Manson.
Sir Charles Manson, yeah. No,
Richard Branson.
Whoa.
Sir Richard Branson owns Virgin Galactic.
That stock was $8 2 months ago. It hit $42
Do you know why it's so high? Well,
it's a rocket ship.
Yeah, and you know what?
What?
The world's elite are going to get on it after they finish infecting us all with Ebola virus, and they're going to go to Mars, where Elon Musk is waiting with a giant chateau pre-built running on lithium-ion batteries, where they will drive around in Teslas, drinking champagne and snorting cocaine off of the rumps.
So would you weigh more or less
girls.
in Mars? Would you weigh more or less in Mars?
Well, you'd weigh exactly the same.
No, you would not.
Well, I would.
No, you wouldn't.
Yes, I would.
No,
I've been known to defy gravity.
No, smaller planets.
You're talking about mass.
Talking about gravity.
Or weight.
Well, same thing.
Mass and weight are not the same thing.
No, I'm not saying. I'm saying on the moon you weigh one sixth of what you weigh.
Well, I don't.
That's what I love about James. He argues about everything. Who?
Anyway, Seth, we better get on with the show because otherwise we're just going to be sitting here.
Anyway, the answer is you'd weigh less on Mars.
Oh, that's not my answer. Hey, did you see the people in the control room came back from Mexico today, and one of them is particularly brownish.
Yeah, right.
Tanned.
Tanned.
Can we get a shot in the control room? Suzanne, show us your tan line.
Show us your what?
Your tan line. Hashtag me too. No, I'm just kidding. We're not going to show tan lines here. What do you think this is? You're not paying attention to what's going on with Harvey Wallbanger? What's his name? The guy, the director, Weinberger?
You know what, boy, there's some testimony that's coming out of that that's just so...
devastating? Do you think he's going down?
He's going to the slammer.
He's going to the slammer.
Yeah, but you know what? He can hardly walk anymore, so maybe he'll...
I think that's all a put on just to get sympathy.
Maybe he gets a nice little...
Does he have any redeeming qualities? So
I don't know.
Okay, well, anyways, we could go on and on about that. But let's talk to Dan McDermitt from thechartguys.com. He is one smart motherfucker. Dan McDermitt joins me now from thechartguys.com. Dan, welcome back.
Thanks, James. Glad to be back.
Dan, what are you seeing in the marketplace today? It looks like a bit of a sell-off underway.
So the S&P 500 the last 2 days has been a bit weak, and of course the weaker we are, where we stand in time right now, the more the narrative of the coronavirus is going to be talked about by the talking heads, and that's just going to propel some fear. So essentially the marijuana sector reached a point where CGC had its earnings, and it started to pull back a bit, profit taking on a gap up open, some shorts saying, the sector's been weak, we can just jump in again. We reached a point where after a few days of a slow pullback, we reached a bottom base. And the bulls showed up yesterday in a big way. We were up at one point for CGC 6%, other names 4 to 5%, and then right in the middle of that bull momentum, the S&P 500 dropped pretty much 1% almost in a half an hour span. Just an all-out little waterfall dump, which eventually recovered, but that was enough to pretty much stop in its tracks the bull momentum that the MJ sector was seeing for the first time in quite a long time. So just poor timing for the sector. And right now I'm looking at a sea of red out there because the S&P 500 is down 0.9% again. So just can't catch a break for the sector bulls.
Right. And so how much of that do you think is related to the coronavirus? I know you're not really that interested in the fundamental picture, but there must be some sort of influence on your thinking by the continuing spread of the disease.
Definitely, it's a factor. I'm not going to say it's not a reason for anything. It definitely is. It's the kind of thing where if coronavirus weren't a thing right now and the same price action were going on right now, they would point to the Democratic debate and they'd say, Bernie or Elizabeth Warren performed better than Mike Bloomberg, so the market is responding to the potential. There's always going to be a fundamental narrative that they tie to price action.
Right.
But I personally am paying a little bit more attention to the coronavirus, and I actually just did my prepper thing and bought a whole bunch of dried food and some medicine and just upped my game a little bit more just in case. Why not prepare? So we're getting some numbers out of China. I saw one about the first half of February. Car sales are down 97% year over year. So it's definitely going to have an impact. And the fact that the S&P 500 has been at all-time highs while this is going on, it seems like a little bit of a detachment between the reality of things and the price of things.
Mm-hmm. Well said. Well said. Is there anything in your technical sort of indicators to suggest that the coronavirus could, in fact, catalyze a really steep global recession?
I would say yes. I mean, just the fact that the S&P 500 right now, since the dump December 2018, it's been in a weekly uptrend for pretty much a year and 2 months. So 14 months of a weekly uptrend. We're due to lose that weekly uptrend at some point in the near-term future, in my opinion. Whether it's 1 month from now or 3 months from now, I don't know. I'm not going to try and pinpoint the top. But I am in a bearish S&P 500 position currently with a stop loss set just in case this is that more meaningful pullback that we have not seen in the last 14 months. So we're so overextended. It's the kind of thing where I'm not going to fight the market bulls. I'm not going to fight the Fed pumping money in. But I'm going to position myself in low risk spots where if this is the one, I'll make some good money. And if it's not, I'll have a small loss.
Right. Okay. And so what kind of other assets do you look at when you see this kind of a sort of extreme volatility materialize around what looks like a geopolitical event of some magnitude?
So gold, I've been in a long-term gold position for 2 months now, which is really long for me. I haven't held anything for 2 months in a long time. But I can't tell you how many times in the past 2 months I have said gold's positioning with the strength in the dollar and the strength in the S&P 500 is putting it in a very good position. And then from there, we had a little bit of Iran scare, and then we saw gold move up. And then the same thing, and we had a little bit of coronavirus scare, and gold moved up. And then yesterday, a little bit of market weakness, and gold's hitting multiple year highs. So we're definitely noticing, okay, gold's going up, and it's not the normal inverse correlation reasons. It's almost like people are preparing for a market pullback before there's any signs of a market pullback and treating it as a safe haven asset to a certain degree. Right. Okay, so do you expect the volatility to continue into the near term, or do you expect it to sort of relax a bit, or is it too hard to tell based on what might yet be headline sort of catalysts? It's definitely going to be looking like some short-term volatility is going to be here. What the bears are showing us is they can push the price down really fast and hard really quickly. It's almost like they catch the bulls off guard. And then yesterday it lasted 30 minutes, and we had a bull grind the next 3 hours to the end of the day. This morning, it was 20 minutes of a flush, and now we're having this slow grind recovery. So we're not really getting meaningful follow-through. I want some clear lower highs and lower lows on the hourly, on the daily time frame to prove follow-through. The burden of proof will be on the bears in this market as long as we are in a weekly uptrend, and just not seeing the notable follow-through. I mean, when's the last time we've seen in the S&P 500 2 or 3 red days in a row? It's been a long time. So we have to see that kind of follow-through for us to say, okay, the market cycle is shifting a bit. The bears are showing us something that they haven't shown us in months, and that's going to get a lot of attention if that happens. The question is, will it happen? You bet. All right, Dan, let's take a look at the charts and see if they can bear out what you're telling us.
So checking in first to the S&P 500, we can see we leveled out a little bit, sideways trading, and they're pulling back the past couple days. The long lower wick yesterday shows us, yes, we dipped hard, but the bulls bought that dip. And today we did drop to a lower low, no notable bear follow through yet, and the bulls trying to see another lower wick, showing the bulls buying the dip. So the most important time frame for me, as I talked about, is the weekly chart. This weekly bounce from the low of end of 2018 was a V-shaped rocket ship, and the most important higher lows from there were right there, another here, and every time those dips were happening, we were saying as long as the weekly uptrend remains intact, this is a buy the dip scenario. Well, here we are with the last weekly higher low at 320.73. So as long as 320.73 on SPY holds, this weekly uptrend remains intact and it keeps the bulls in complete control. So with where we stand right now, we still have about 4% that we could pull back while maintaining the weekly uptrend. So if you want to see a notable longer term shift in the momentum away from the bulls that we've been seeing for 14 months, have to lose the weekly uptrend. And there's still a bit of cushion for the bulls to work with for now. Onto gold, we can see gold breaking out. So we look longer term timeframes. The weekly chart has just been a beast over the last couple of months. Let's go to the monthly chart and really condense things down. We're making our way back up through an area with limited resistance, and we are looking back towards that all-time high. That all-time high is still roughly 18% away, but some really nice momentum for the last couple of years in gold, and looking for that to continue. I'm using the weekly time frame as my guide on gold, walking up my stop loss with every weekly high or low. And last, to wrap it up with the MJ sector. So this is what I'm talking about with the earnings gap up, profit taking from the bulls, bears jumping on things, weekday, the next day, weekday, the next day, volume dropping off, slowly running out of selling pressure. And then yesterday the bulls said, okay, we're done. It's time to show up. Big day and a big upper wick, giving it back. And now we're looking towards the lows here because of market conditions. So bulls were real close to shifting momentum in their favor, but bad timing. So the entire sector is still at the mercy of the S&P 500 to a certain degree, and timing does matter. I personally am taking the viewpoint in the MJ sector where if there's short-term clear trades that stand out to me, I will take them, but otherwise I am looking at time frame and seasonality as the most important factor. If we get towards the summer and nothing notable has happened with major news or major volume, then I'll start paying attention later summer as we start to approach the fall and election season.
Dan, thanks for joining us again. If you want to see more about Dan McDermitt, go to thechartguys.com. We'll see you next week, Dan.
Thanks, James. See you then.
If you're enjoying the show, subscribe to Midas Letter on YouTube so you stay up to date on everything investment. Corey Hamill is a rather talented head of research over at Paradigm Capital, and he sends me a note every morning, which I usually ignore because if it's not my idea, then I don't want to read it. No, I'm just kidding. I am kidding. Corey, I read your stuff all the time. In fact, I do believe I've tried to get you on the show. I don't believe that you're interested, but that's fine. He made a good comment today about Consortium Inc., which trades on the CSE under the symbol TIU.
You mean consortium? Consortium.
What did I say?
Consortium.
Consortium.
Cannabis.
Oh, no, Canada.
Oh, Canada.
They can. Yes, we can. Anyways, we digress. Let's not get off the topic. Jesus Christ. Consortium, trading on the Canadian Securities Exchange under the symbol TIUM. He was saying that Consortium has generated record weekly flower sales of $323,000 USD in revenue. Now let's just extrapolate that, Edward. $323,000 USD times 52?
15 million. 16, 17 million, 18 million.
Really?
Yeah.
Well, okay.
Annual.
Right. Okay. Well, Consortium is looking at quarterly sales of 9.8 million, according to Corey. Anyways, he has this. Yeah, he's got this great chart here. Now, what did I do with that? It was there right in front of me.
320 for the week is like 14, 12, 6, 8, 12, 8, 12, 8, almost 13 for the month. 13 times 12.
Okay, so look at this.
Chart.
Market share.
Yeah.
Milligrams of oil. These are sales per store, trailing 3 week. Grams of dried. Can you not see this? What the hell? Okay, how about that? No? Damn it. We're having technical difficulties here, people. Bear with us. I'm going to switch this over to preview. Here we go. How about now? There we go. Okay. This is what I'm talking about here. This was provided by Corey Hamill at Paradigm. Kudos to Corey. And this shows like grams sold per store, trailing 3 weeks, and gives you a real good look. Like, look at Trulieve down here. So Trulieve just passed 45 stores in Florida now. And despite the short report that basically regurgitated known and historic information in a way that did bring the share price down by a bit. So they're feeling pretty smart, but really they're just assholes that, basically brought a good company lower. Yes, they have some court issues, and but my point is that look at these sales here. They're the highest selling store in the U.S.
Which one?
Trulieve, 7,000 grams.
Yeah, no, they're
dried flower.
And we've said it all along. It seems to be a company that's focused.
Yes.
That's doing it over and over and over again.
Yes. Yes. That's why Trulieve is one of our top picks in our subscriber newsletter, and so I do believe that company, once all the negative press has subsided, will soar into the stratosphere. Now, I can say that because they're not a client and I don't own the shares, so there's no reason for me to say that unless I only actually think it is. And actually, it's not even me thinking that. It's Corey. No, just kidding. He's not making any predictions. But my point is that with this kind of robust data, one can really get a good shot of what's going on in the cannabis space. Anyways, enough about that. I want you to listen to Mr. Wolf Richter here, the publisher of Wolf Street, as he tries to decipher what's going on in the Fed. I'm joined now by Wolf Richter. He is the publisher of wolfstreet.com. Wolf, welcome.
Thanks for having me.
You bet. Wolf, since this is your first introduction to my audience, can you give us a quick thumbnail on how you come to know so much about the Fed and its operations?
Well, I'm a Fed watcher, so that is one of my little niches that I'm in, and it started in the financial crisis when the Fed started doing all sorts of shenanigans, and it is fairly transparent about some of the things that it does. So it publishes some of the data so you can actually look at it and see it, and it's just been a fascinating experience in how it has progressed. Essentially manipulating the markets and taking any kind of price discovery out of the bond market, especially, and that has been it's one of its primary goals. So it wants to set interest rates, and meaning market rates. It wants to set market rates. It can't really set them, but it wants to manipulate the markets to where they have particular rates, and it's just a very fascinating experience to do that.
Sure, you bet. You wrote an article on February 7th making the case that the Fed was winding up a sort of de facto quantitative easing operation in the guise of overnight operations in its repo market since September 2019, when there was a sudden spike in the overnight rate of interest that the repo market participants were willing to lend money at. Can you outline for my audience, please, how this repo market works and how that operation affects or sort of replaces QE when they resort to printing extraordinary quantities of funds to service that interest rate?
Yeah, so let's briefly go back a step. There are four big things that the Fed does with its balance sheet. Two of them were part of QE, and so it would buy Treasury securities of all kinds, except Treasury bills. So those are the short-term bills. It didn't buy any of those during QE, during the later stages of QE, but it bought the long-term securities, and then mortgage-backed securities. So it would buy those mortgage. During the QE unwind that started in late 2017, it started shedding those securities by letting them mature and roll off the balance sheet. And then that worked fine until we got that stock market plunge in late 2018, and then the Fed sort of did a U-turn on these two items, on mortgage-backed securities and Treasury securities, and gradually stopped the unwind of those. And then we got, when it just had stopped them, essentially we got the repo market blowout in September 2019. And so now it added two more components to its toolbox. And so there are now four components. And so the two it added are the repos, the repurchase agreements, and buying T-bills, so Treasury bills, short-term Treasury bills. And they don't always go in the same direction. For example, it is still shedding mortgage-backed securities at a rate of about $20 billion a month. And so that's happening. That continues to happen. The Fed wants to get rid of its mortgage-backed securities, and it's unwinding its positions gradually, getting rid of about 250 billion a year. And that rate has continued. Then it had in September, it started getting into repo. So these are repurchase agreements where it sells, it offers a certain amount of cash for treasury securities and mortgage-backed securities to the repo market. And these are short term, so some of them are overnight repos. So there's a repurchase agreement. It means I sell you something, and then we agree that the next day we reverse that transaction for a slight gain for me. And it's like a loan, but it's really a purchase with an agreement to repurchase the original item. And so the overnight repos then unwind the next day, and the Fed does them every day. And so they go to zero the next morning, and then there's a new one coming after that. And that goes to zero the next day, and then there's a new one. And then there are so-called term repos, and the current ones there for 2 weeks, 14 days, and Fed does 2 a week. And so there's always 4 of them outstanding, and they unwind in usually 14 to 15 business days, and then there'll be another one. So, for example, this morning, it did a 25 billion term repo. So this is down from the 35 billion repos it did late last year and earlier this year. So it is gradually reducing the amounts of these term repos. And so from 35 to 30 billion, and now we're down to 25 billion, and pretty soon we go to 20 billion. And so it's gradually taking those off the market. There was a 50 billion 30-day repo that it did in December that carried through early January. That unwound without replacement. So when these repos unwind, the balance on the Fed's balance sheet go to zero. Everybody takes the Fed gets its money back, and the counterparties get the securities back. So this has had the effect that the repo balance has plunged from about 260 billion at the end of December to about 164 billion now. And because it's gradually winding down, it got rid of the 30-day repo. It's gradually winding down the 14-day term repos, and the overnight repos have been undersubscribed all year long. So they're now running in the range of 30 to 50 billion a day, and they unwind the next day, and then there'll be another one. So this entire repo episode is winding down. And the Fed is now discussing a permanent repo facility, which would be there if these repo rates spike. And so there wouldn't be any big to-do about it. The Fed could just step in. It used to have a standing repo facility before the financial crisis, and it used it constantly. So there was constant repo activity. During the financial crisis, the Fed started buying all the securities, so it ended the repo program. Now it's thinking about reinstating a permanent repo facility that will interfere in the market on a fairly small scale when needed. Yeah, and so the repo thing is now winding down. The T-bill thing is doing the opposite. So the Fed has decided that one way to solve the repo blowout is to add liquidity to the system via short-term treasury securities. So the Fed is buying those short-term treasury securities at a rate of about 60 billion a month. So it means that it's buying them at a rate of 50, it's adding to its stash at a rate of 50 billion a month. They mature constantly. They're 30 days and 90-day securities, so they're now maturing. And when they mature, the Fed replaces those, and in addition, it adds about 60 billion a month. So we've got those three different directions going. The mortgage-backed securities are declining at a rate of 20 billion a month. The T-bills are increasing at a rate of 60 billion a month, and the repos are now declining at a somewhat uneven rate, but have come down quite a bit. So the net effect has been that in terms of the Fed's overall assets, they really have not moved since the end of December. They kind of wobble up and down a little bit, but they have been essentially flat. So that huge pileup of assets that it did, that $410 billion that it added, from the mid of September through the end of December, that's still, those assets are still there, but they're not increasing anymore. So the QE part of it is essentially gone. It's just maintaining its levels right now by increasing on one side and decreasing on the other side.
Wolf, I could probably talk to you for hours and hours on end. Unfortunately, we've run out of time today. I will come back to you, and I really appreciate your time today. Thanks for joining me.
Thank you, James.
If you like the show, you'll love our website. Visit us at www.midasletter.com for interviews with key CEOs, cannabis news, and to subscribe to our newsletter. Anyways, there, that's our show. Goodbye.
He knows probably as much about what's going on at the Fed, and you got to admit it's an arcane.
Now, wait a
world.
second here, young fella. Just before you go off on that tangent,
okay.
I'm supposed to say this. If you would like to see the full interview with Wolf Richter, which went on for 17 minutes because I did not want to interrupt him because I was learning so much from him as he was speaking, go to our website and check out the Wolf Richter full interview. Very interesting. But so, bottom line, now we can go into the tangent. What were you going to say?
Here's a guy that knows what's going on, and
Where?
about where?
You got something in your pocket, or are you just glad to see me?
Yeah. And a flashlight?
Flashlight? Boy, that's a big banana. Anyway,
but I confess I don't know much about what the hell this buying and selling and blah blah blah. But the bottom line is what? What's the bottom line?
Well, the bottom line is
we're digging a hole.
Well, the bottom line is that the Central Bank of the United States actually quantitative eased the economy by something to the tune of $400 billion since September. And now they're saying that we're going to wind down these term repo structures.
They can't.
Well, no, they can, but they're doing it by buying T-bills, which are short-dated treasuries of less than 1 year's duration.
Yes.
So each time they settle their treasuries, they have to actually buy enough to settle their last obligations, and then they have to replace them with another whole lot. So in other words, the Fed has come up with an ingenious way to say we're going to step up the pace of quantitative easing while pretending that we're not.
But they figured out another option.
Oh, it's just like our good friend George Sophilopoulos says, it's all bullshit. It's all bullshit. Anyway, so look at the price of gold now. This is the interesting thing. Sophilus.
Yeah, you know what? Where you got
George
that? It's
Sophilus.
It's all for bullshit. He got it from
TS.
me.
No.
Yes, he did.
No,
I was with him in Static in Vancouver, and I kept telling him.
Are you losing your memory? You told me that he told you that.
No.
From years ago.
No, because I didn't know him years ago.
George, if you're watching, can we get you on the hotline? Where's that yellow phone?
I kept saying it's all bullshit, and Stadnik kept saying it, and then George.
Yeah.
It's all bullshit.
I think we're going to have to discuss this over large quantities of alcohol and drugs. That's what I think. Anyways, no, I'm just kidding. I'm too old for that
happy
nonsense.
hours around?
Happy hour. I'm happy. Hope you're happy too. Anyways, let's check in with Alan Brochstein. Here's Mr. Brochstein all the way from Houston, Texas, where they all talk like this, except Alan doesn't. He talks like a regular guy. Alan Brochstein joins us now. He's from 420Invest.com. Alan, welcome back.
Hey, it's good to be here, James.
Alan, here we are, just approaching we just passed the middle of the first quarter of 2020, and the stocks in the cannabis sector, both U.S. stocks and Canadian stocks on the large cap side, seem to be finding a bottom, while the smallest cap, let's say the micro caps, are changing names and disappearing before our very eyes. What's the driving force there?
Yeah, so I think access to capital is really driving this, and it's a dangerous game. To raise capital the way some of these MSOs are, in terms of we're not going to sell our equity; it's too low. We're going to sell our assets in the sale leaseback, or we're going to take on debt when we're not quite cash flow positive. So, and I'm not saying that's the wrong thing to do. I actually think there's a strategic understory here, but That's what we see the largest MSOs doing is it's become harder to raise equity. And that leaves the smaller companies in a really tough spot because the big guys, and this is where it gets strategic, I think they're taking capital just to keep other people out maybe. Interesting conspiracy theory, but you do the sale leasebacks and you take on the debt when others can't and nobody can sell equity. And so, I think a lot of companies face some very tough choices in terms of their financing right now. And so anyway, we're seeing the 4 or so largest MSOs, and you could probably extend it a little bit deeper. It actually goes deeper. I mean, companies like Harvest, which just under that, seem to be finding a bottom too. So, I know everybody wants these stocks to go up. First, they have to stop going down. So that's a start. And when you look up in Canada, Canopy Growth, Freya, and Kronos Group, 3 of the big 5, found bottoms in 2019, have held them so far. Tilray and Aurora may have found bottoms. It sure looks like, it was a little bit later. And these two have had active ATMs and a little bit more stressed on the balance sheet. So I think it's shaping up for, if you're investing in these small companies, you kind of got to root for the large companies to find their footing first. And that'll give people confidence to put some money into the smaller ones, would be my guess, James.
Sure. I saw an announcement that the HMMJ Horizons ETF was going to be absorbed by the HMUS, HMJUS ETF.
Hey, I think you have more money than that ETF has, James, just in your own personal account. So I wouldn't sweat that too much. And I think, look, I was really critical of all these ETFs that came out. Thankfully, HMMJ, the big one, got better. When it first came out, it was really concentrated and was really just something that would have been really easy for people to replicate on their own. It was just a few LPs, really, like 5 names made up 50%. But that's gotten better, and kudos to those guys. But they drank their own Kool-Aid, and they started these other funds, and they've just never been able to get the assets up. There's only one other ETF that really hit critical scale, and that's that MJ. And then after that, it's really all downhill. And we've seen there was another fund complex that decided to close theirs. I don't even remember. It just never even hit scale. I think Evolve, if I don't want to say the wrong one. I'm pretty sure that was it. So the ETF, or the idea of having one investment represent the sector, it's a noble idea, and I get it. It's just been very challenging. And the main problem, I think, has been anybody that wants to invest in the sector should want to have at least some of their exposure in the United States, and it's really hard for these ETFs to get that done. Yeah,
you bet. Okay, so some companies in the U.S. MSO space have continued their downward spiral. MedMen comes to top of mind. I guess a little bit rudderless right now with the departure of Adam Bierman, and quite the eating of humble pie on their part to have to take away that super voting structure, which is a plus. And but still the market doesn't look like they've forgiven them, or it hasn't changed the interest of the market. Why do you think that is?
I think people are going to be slow to embrace certain names. I put MedMen and Aurora as maybe the poster children of. It's funny. I used to always say MedMen is the American Aurora, and it's really turned out to be, unfortunately, true. And both these companies, they're not the only ones, by the way, but they're kind of at the extreme of empire builders and build it at any cost. And we can make no mistakes, and yet both companies made a lot of mistakes. And so now it's time to see if they survive, and I think both of them will. But the question is how much dilution they'll have to absorb. I think it's easier to fix Aurora than MedMen, mainly because it's federally legal for Aurora. And, I've been doing some just basic math. If there were a strategic buyer that wanted to invest $2 billion to take a 50% or 60% stake in Aurora, it'd be a little bit dilutive, but I think the stock would go up 50% just on that news. For MedMen, a little bit harder to get a strategic buyer because of the federal illegality. So that's not happening, and it's going to be more of a slow build. I actually, I think it's a high risk, high reward opportunity. I feel like they were a little bit late to address the concerns, and I don't think Adam Bierman was really the right person to lead that kind of company. You know, a lot of times we find founders with vision are really good at that part, but they're not necessarily good at running a company. And I think that was the case here. So I think anybody looking at the situation has to realize, you know, the shares have been coming unlocked, and that puts pressure on the stock. And those people that hold those locked up shares don't like MedMen. They're happy to sell, probably at any price. And that's been part of the story. But, you know, stay tuned. The company has a very strong presence in California and as well in Nevada. They have a strategic asset in Virginia, a small asset in Illinois. I think they're selling another of their assets in Illinois. That's what I'm looking for, James.
So that's an abbreviated version of what Alan Brochstein had to say. If you want to see the full conversation with Alan Brochstein, you're going to have to send us $50. No, just kidding. It's free, and it's on YouTube, and it's on our website, and it's on Facebook, and it's on Twitter, and it's everywhere in the YouTube universe. Soon it'll be on TikTok, and we'll be TikTok famous. Woohoo! We'll never be TikTok famous. We're way too old. Old farts don't get TikTok famous. That's just the way it is, Ed. Did you know that? We have no hope of being TikTok famous. Damn. Well. Anyways, I want to say hello to all of the people in our audience. We have a stunning 60 people observing our antics today, and some of them are very familiar to me. Particularly, a big shout out to Zippity Doodah, who says our show sucks the hind tit, which is absolutely correct. We have Keto Static. Keto diet. No.
Okay, what's the country that keto is the capital of?
Keto? Tokyo.
No.
What, Tokyo? Keto Static Bapanifi. That's what I was trying to say.
Ecuador?
Quito.
Yeah, I think so.
Is it Quito? Is it Guayaquil?
It's Quito.
I think it is Quito. That's the capital, isn't it?
Well,
it's not Guayaquil.
Geography is my major.
Geography is your major?
Well, I've got about 50 of them.
Okay, where are you right now? See?
You know what the capital of Ontario is?
Ontario is Toronto.
What's the capital of Canada?
Ottawa.
Not the same, is it?
No, well, they're close to each other, though.
No.
What's the largest city in Canada?
Toronto.
What's the third largest city in Canada?
Vancouver.
Used to be.
No, Montreal.
Watch. Tune in as Ed and James try to stump each other with mindless grade 3 geography questions. That's next show. So we're going to give it another shot here, but I wanted to say hello to, there's a gentleman on the show here in the chat group called Works Guy, and he keeps repeating his question because I suppose that we haven't responded, and so he's trying to get our attention. He says, I am down millions from Wayland Group. Pot stocks screwed us all. What happened to Wayland Group? Well, here's what happened. It went down, and you should have sold. Da-da-da-da! Boy, that's why they pay us the big bucks, right, Edward?
We distinctly, I recall distinctly that when pot went legal,
yes,
I said it was perhaps akin to a mining company that started to mine. And usually the high is hit just before it starts to produce because there's a myriad of problems, and we've seen nothing but problems in the marijuana space.
Yeah.
But maybe now we're bottoming because everybody's throwing in the towel. Maybe. That's when the bottoms occur when everyone thinks
it's all over.
It's all over.
Got a hangover. Who can name that song? Gold morning in the sun. Blue moon when the window closed. I can't remember words. Anyways, onward here. Onward. Bruce Campbell is here all the way from the left coast with the Stonecastle Investment Management, Stonecastle Market Minute, whatever we're calling that. Here he is. Bruce Campbell joins me now from Stonecastle Investment Management for the Stonecastle Investment Management Cannabis Week and Corona Week update. Speaking of Corona, Canadian beer sales down 3% in 2019, being blamed on cannabis. What's the story there?
Well, I guess this is the largest drop in 7 years for beer sales, down, and it's being blamed on cannabis. And the interesting thing is that we don't really have cannabis beverages out yet, so they're just saying that people have consumed less beer because they're using cannabis in different forms. everyone still continues to think that beverages are going to be this huge segment. I don't necessarily know if they will right off the bat. I mean, you basically look at the data in the U.S. and there's still a pretty small little fraction of what's going on. But it'll be interesting to see when they actually do roll out the beverages, if it has another impact. If 2020 sales are down again, then I guess you can see why some of the beverage companies have got into the cannabis space. Obviously with Constellation, right?
Sure. You mentioned that Canadian sales data from December was showing 8% month-over-month growth and 146 million annualized at 1.8 billion. That's not a bad number. That's almost as much as the state of Colorado.
Yeah, I mean, what we're seeing is a continual ramp up. So if you look at that 146 million and annualize it, it's a 50% growth rate over the previous 12-month period. So we're approaching that kind of $2 billion sales mark. If you look at Colorado, they have about 6 million people, give or take, there, and their sales are about the same as our monthly. They're about the same as our monthly annualized number. Right. And so if you take a look at that and sort of extrapolate out, that makes the Canadian market sort of in that $10 to $11 billion range, which is what originally everyone said it would be. Obviously, we need to grow into that, right? Where we need to get the stores, the locations, and get people who are in the black market coming over, and obviously having new people who have never experienced cannabis or who haven't experienced it for a while, get those crossed over as well. There's 750 retail locations right now. And when you think about that again, if you just look at Ontario, there's over 2,000 locations to buy beer and wine and alcohol, compared to 750 locations across the entire country. So you can see where that retail has to really expand before we can see probably a pickup in sales.
Sure. And is there any reason to be optimistic about the increase in retail distribution points in Ontario, for example?
Well, they continue to say that they're going to roll it out, and I think they were talking about 20 per month is what they wanted. I just recently was talking to a retailer this week, and they said that there was a sort of last minute change, that they had their own theories on why this might have happened. But I guess the latest was that it wasn't going to just be a straight lottery, like as far as like who got in first would get access to these licenses, but they were actually going to look at who was prepared and who was ready. So it kind of takes away anyone who doesn't have capital and hasn't built a freestanding location out of the competition to start these new locations. But that being said, there are lots of sort of well-capitalized groups between the LPs and some of the public companies that are on the retail side. So I don't think there's going to be a problem. It's just going to be a function of like whether or not they can get them ramped up in that time frame, that 20 per month. But certainly that would help if we saw that through kind of the rest of 2020 and then into 2021.
Mm-hmm. Okay. Another news item that caught my interest this week that I'm sure you'll have some comment on was the merger of the HMJ and the HMUS ETFs merging into the US ETF. Does that sort of give us a indication that that's where the money is? Is it going into the US more so than Canada?
Yeah, I mean, I guess it depends on how you look at it. I looked at it a little differently. We saw the Evolve ETFs announced that they were shutting down, and then I think this is kind of the next evolution in that. And what it really is showing me is that money flow from kind of the retail investor has really disappeared out of the market, and we can tell that by the stock prices that these things just continue to drip down and go lower. They're not maybe they've bottomed out here, but they're not certainly having any big moves upwards. And I think that's just a function of lack of investor interest. If you look at those two ETFs that they're merging, I think one has around 3 million in assets and the other has just a little bit less than 20. So, from Horizon's perspective, they're trying to make it efficient and obviously take advantage of the economies of scale by putting them together to reduce some of their costs and still manage the same assets, and then hopefully grow it down the road. Obviously, the US is where the opportunity is. So what they said is we're going to get rid of the junior LPs and just have the US LPs or the MSOs, and that would be the product that they run going forward. And these will, ebb and flow obviously with dollar amounts. It's probably not unlike what you would have saw if you had a, there wasn't a lot, but if you had a technology ETF back in, sort of the 1999, 2000, 2001 era.
Right. Bruce, the BC bud tenders gave notice that they want to unionize. That was an interesting headline.
Yeah, I'm a little surprised that it's happened this quickly. You in an industry that's not really that old. It's surprising to see that they're already looking for the benefits of being in a union. If you look at other industries, something as an example like WestJet, it took them probably close to 15 years before they actually got unionized, and now in an industry that's a couple of years old, the bud tenders are already in the process of unionizing. But I guess that probably also has a large part to do with the fact that it's in BC. You didn't see the Ontario bud tenders announcing that. I mean, maybe it grows to there or moves to there, but it's kind of more along the lines of sort of the socialist feel that we have out here in BC.
Yeah, right. Interesting. So, do you think that the unionization movement will spread to other sectors of the marijuana sector?
Certainly it's potential, right? I mean, once they get their foot in the door, that's what the unions always will push for, right? At this point in time, I think the wages have been probably pretty good in the sector. That being said, we've seen a number of layoffs in the last probably 60 days here. So, I think there'll probably be a bit of a tightening in the amount of compensation that's handed out. And so that would certainly be a ripe time for unions to move ahead with their unionization.
It strikes me as a little bit disingenuous to try to organize a union at a time when the entire industry is suffering financially. I mean, there's just no way that unionizing does not add a huge cost to the labor bill of these companies, and it might actually only serve to accelerate the demise of a lot of these companies. Don't you think?
It certainly could, yeah, for sure. I mean, that's as you say, the expenses are going to rise if they're successful in unionizing. But I suspect that the people who are sitting in that position where they want to unionize haven't really given that thought that, hey, maybe we should be happy that we're in this growing industry and we should let it breathe before we try to stomp on it.
Yeah, right. So do you think that would, and then my point being that, on the other hand, if they accelerate the demise of the weaker LPs out there, they're going to accelerate the profitability of the larger LPs who survive, arguably.
Yeah, probably what it does is, if you look at it from a retailer perspective, which is where the bud tenders are, it's going to put pressure on anyone who's a smaller operator who's trying to manage, maybe just one or two stores. So you could see an acceleration in sort of the bigger conglomerates where they have, 30 or 35 stores now that, they probably can pick off, smaller stores that aren't as profitable because of a unionization and, bring those in, obviously economies of scale and synergies and make that actual profitable for them to operate versus, the guy who's just got one or two locations.
Right. So then going back to Colorado here relative to Canada for a moment, I didn't notice that was a topic later on in this conversation, but you extrapolate, so Colorado sales at 1.7 billion. If you extrapolate that to Canada, you come up with the figure 11 billion. Is that based on a per capita usage?
Yeah, that's correct. That's just taking the population and extrapolating it out and that's, if you go back to when Canada was first legalizing and, all of the analysts were trying to figure out what's the size of the market and what should we put as a multiple on this market. A lot of people use that where basically Canada's, 6.5, 7 times bigger than Colorado. That was one. And so they took extrapolated out the sales per capita there to what the sales per capita would be in Canada. And so, most of the research reports that came out initially on the size of the Canadian market put it somewhere in that sort of 9 to 10 billion, sort of $8 to $10 billion mark, based on how much rec and medical you put into those formulas, is what they felt was going to be at full maturity. And if you look at Colorado, it's obviously been through all the growing pains that Canada's dealing with now. They have a full retail distribution network. They've got, supply that's, been oversupplied and now has come back in line. And, that sort of shows you that based on that population number, we should be somewhere in that kind of, $10 to $11 billion range is what I'm saying.
Bruce, well, that's a great update for the week, and I thank you for your participation. We'll come back to you next week.
Yeah, thanks a lot. Have a good weekend.
You too. Yeah, so that's interesting. Bruce says that the Canadian market, if we extrapolate it from Colorado, would be worth $11 billion. Do you know what that would do for the Canadian landscape after the 30 or so companies that are going to go belly up completely? You know what that's going to do for these companies? $11 billion. Say, okay, so there's like, what is it? There was 60 Canadian LPs. There's going to be 30 again. And 30 LPs are going to split 11 billion. What's that, Ed? 11 billion divided by 30.
11 billion divided by 30?
Yeah.
About 300 million.
Each.
Yeah.
So that would be...
No, in total.
Oh, what
30,
a tricky
about
fellow here.
Remember, at the turn of the century, when the automobile...
He's going to say something.
When the automobile started being produced, you know how many car companies there were?
How many?
100, 200, 300, whatever. It's the same variation on a theme. Okay? Variation
on the theme.
In other words, everybody flows in.
Prelude to a Kiss?
Three exist now.
Smack or Kiss?
Bus.
Wow.
You ever heard that one?
That's a...
Give me a little bus.
No, a little bus.
B-U-S-S.
Oh.
That's a Kiss.
Oh, wasn't that nice? Bisous in French.
No, the point is, everybody flocks in, but only the strong survive. And so we have,
Some people flock off.
Flock you.
Language. This is a G-rated show.
Yeah.
So just want to let you know that YouTube has stopped us from monetizing any of our videos. So we are commercial free against our own desire. It was only a couple $100 a month we were getting, but YouTube, owned by the evil Google empire, doesn't want us to exist because we take too much traffic from their advertisers who pay them big bucks for advertising. Anyways, that's my rant for the day. Lance Ippolito joins us now from the Future of Wealth. Lance Ippolito joins me now. He's the publisher of Future Money Trends on the Wealth Press Network. Lance, welcome back.
Hey, James, how are you?
I'm doing well, thanks. How's your trading day going today?
It's been weird, very weird. There's more cases of the coronavirus. It sent the futures down about 20 handles, and now we're stabilizing. But the market's been pretty volatile this week. You had some rotation out of the big tech stocks like Apple, Facebook, Microsoft. And then today, pretty light volume, but we're starting to see some money flow into gold and bonds, some safety asset classes. So could start seeing more volatility in the markets.
Right. And so from an options perspective, what's the trade? What's the play today?
Michael's, the art store, actually. And that sounds really odd. And probably not a lot of people know that Michael's is a stock. It's very low price, only about $5, $5.50. But over 30,000 calls in Michael's have been trading today, and it normally sees not even 1,000 call options a day hit. And then Gilead, another name hitting the options market today, over 77,000 calls in Gilead. Most of these were short dated from next week, February 28th expiration to March expiration. I think what I'm hearing on the street is they're looking at a coronavirus possible cure.
Right.
And I think that's what these option players are betting on. Obviously, if they find some treatment for the coronavirus, Gilead stock should see a nice bid to the upside.
Sure, you bet. So have you been looking for stocks and option plays that are directly correlated to the coronavirus?
I took some Gilead today. It's up now. The stock's up about 3%. The call options are up about 20% already, and I literally just placed a trade about 30 minutes ago. It is, in my opinion, when you play names with binary events, for example, let's say they do have positive news on a coronavirus drug, the stock will go up. If they do have a negative news on the coronavirus, the stock's probably going to see probably see some downside. So limiting your risk in the options market is what I prefer to do. So that's why I'm playing it.
So do you sort of hedge your trades in the options market, go long and short?
I don't personally, just because I like to trade directional options, and I'm what we call a premium buyer, or if I buy calls, I'm buying premium. I'm not an option seller.
Okay.
What you can do to limit risk is spread out your trades. Like instead of buying outright calls, you could buy call spreads. Or if it's in your risk management, and let's say you're very long a specific stock or the market, buying some downside puts as protection, or like a volatility product like the VIX or VXX. That's always something one can do. I think it really just depends on how much risk are you comfortable holding.
Right. Okay. So in this market, does the cannabis space do anything for you?
Actually, and I was having this conversation yesterday. It seems that there may be a trade in cannabis, and the trade is, I'm exposing my secrets already. Yeah, it's like, the trade is, expose it. No. But we saw the Democratic debate, right?
Yes.
And it looked to be, from the polls and, from the media, that Bernie won, or Bernie did well enough, we'll say, not to get into politics. The next day, the cannabis stocks had a crazy bid to the upside. I think Tilray at one point was up about 12%. You had Canopy Growth, Cron, all these names up about 5+%. So it looks to be the trade, especially if you don't want to be committed to some cannabis stocks for months or longer dated,
right,
is to get in the day before the debate, possibly limit your risk with some options, and look to take profits the next day. You could catch a pretty large move. I mean, a 12% move in Tilray. Some of those options paid about 200 to 300% overnight.
Wow.
And really just hope Bernie performs well and he starts doing well in the polls. Again, I think if Bernie starts building momentum, the cannabis stocks, I think investors will be pouring in cannabis stocks.
Yeah, you bet. And what about gold? Gold has been on fire lately. Do you do any options trading that are correlated to gold?
Yeah, so two names I like are Barrick Gold, so GOLD, and
Good
then
symbol.
Newmont NEM.
Right.
They have very liquid options, literally a couple pennies wide. They trade really good volume in the stock and the options, and they move really well. An options trader can also play an ETF like the GDX or the GLD. Those are also potential very liquid names that one can play. I personally just like singling out a gold stock, especially if I have a background with it and I'm pretty familiar trading it.
Right. So those are large cap miners. That's your sole focus. You don't get into the mid tiers or juniors.
I don't in the options market, just because when you start looking at names that don't trade as much volume as those large cap ones, the options market can get a little illiquid, meaning the bid and the ask is going to be a little wide. And as a trader, you want that tight bid ask. I had some members today play around with the Nugget, which is the 3 times leverage ETF. Those are for the people who have some guts, who really like getting leveraged in
Right.
those gold names. But as long as the stock moves, I'm pretty much open to trading anything.
Yeah, interesting. So tell me about your publication, The Future of Money, Future of Wealth, rather. What is the focus?
So what we see in trading in 2020 is we're seeing a large shift into options trading, into your online brokerage platforms, into mobile trading as well. And what I try to do is give real educational tips from my experience in trading for the future of wealth. And we post it on the website. I shoot probably 5 videos a week or so that I upload on real time. This is real time with stocks moving in the market, what I see from overall market direction, and mostly, again, option strategies out there, just because when I started, there was very little YouTube videos. There was a few books on options, but they were mostly selling options. And as traders, the number one thing is obviously to make money, but risk versus reward. And I try to risk as little amount of capital possible to try to hit those big reward trades. So I'm not looking at 10 to 20% returns on my trades. I'm looking for 100, 200, 300% returns in my trading, and that's at the future of wealth, what I try to give our members.
Wow. And in what kind of time frame?
I'm pretty short dated. I trade anything from weekly options to front month options to 3 month out options. Like, it's very rare I have a June position on or a September position on. It's really going to be a stock that I absolutely love, that I really want to hold it long term. It's just, for me, the more time you're in the markets, the more things that can go wrong. So if I could single out a trade for a specific event, I want to do that with my money.
Right. Very good. Okay, Lance. So then, what are you seeing? In terms of, like, we're hearing about the middle of Q1. What do you think is the longer sort of dated expectation for you in terms of the fundamentals of the market that are going to define your options trades? So
I was speaking with a hedge fund manager actually last week, and we were having this conversation of, until something drastic changes with the Fed or with the global markets, money's going to continue to pour into equities. And what's crazy is we're seeing equities, gold, and bonds go up in 2020 together. It's hard to be a bear right now, because we are seeing the markets go up, really, despite the coronavirus, with all the negative news. But it's also hard to be a bull. It's hard to want to buy this market when we're right near all-time highs, and we do have, from a macro point of view, so much negative news out there and so much uncertainty, especially in China, that it's hard for me to commit capital to the long side in a decent position size here. So if I do miss, let's say, the next 10% move in the overall market and possibly the next 20% move in a stock like Apple or Facebook, I'm fine with that. It's just I do think we see the market start to decline, and I want to be prepared for a possible 10, 15, dare I say 20% move lower.
Right. Okay, Lance. Well, that's great intel as per usual. Really appreciate your input today. We'll come back to you next week. Thanks, and have a great weekend.
Thank you, James. I appreciate it.
Follow us on Twitter, Instagram, LinkedIn, and Facebook. Make sure you never miss a show by subscribing to our YouTube channel and clicking on the little notifications bell. Now, I wonder if you've all been noticing that the price of gold is on fire, and whether anybody in our audience has had the opportunity to actually play the gold price in any way, shape, or form successfully in such a manner that they're making money. Edward, have you bought any gold, and what's the story here?
Have I bought any gold?
Yeah. Do you buy gold? You got a gold watch there, I see.
No, it's not gold.
Oh, what is it made out of?
Stainless steel.
Stainless steel? I thought you said that was a $10,000 watch.
Wow, listen.
You people in Latin America, you walk around with a watch like that, you'll lose your hand.
No, because people will say, well, that's not an expensive watch
It
because
doesn't
it's
look that
stainless
pricey.
steel. I know.
It's mostly Rolexes that get targeted.
At the end of the day, if you keep
We're looking at a chart of gold
money
here now. Can you see? Yeah, there we go. So look at that. Even here at the tail end of Friday, it has gone from look at this. What's going on here? February 18th, from 1600 to 1643. Now, the rate at which gold has started to appreciate is the interesting thing to me.
Starting to pick up some steam.
Yes, this is reminiscent of 2006, which was where from 2002 to 2006 it went from $300 to $600, but then from 2006 to 2014 it went from $600 to $1,400.
No, 2011. Peaked in 2011. Sorry to interject, but it peaked in.
Now, Ed, you know that I'm the kind of guy that argues with everything. Fortunately, though, we're looking at the chart here of gold.
Raise my chair. How about raise my hand?
We're looking at the chart of gold.
Okay, let's take a look at the
chart. There we go. Okay, so here we are back here,
and
where the crosshairs are fluctuating.
Okay,
that was September. Let's see here. Let's zoom in. August 24th, was it? I thought it was September when it touched 1920 intraday.
But what year? You said 14?
No, I said 2011.
Oh, I said 2014. Damn it.
See, this is how you win an argument. You change.
You change the facts.
Okay,
Jack.
So what was the date that gold touched $1,920 intraday?
You know, if you think about it, gold peaked about the time the U.S. stock market bottomed.
No.
Yeah.
No.
Well, no, it not entirely, but if it bottomed in 2009, but things were so shitty for the couple of years, gold kept moving. Gold rallied big after the financial debacle.
Well, it took until September 2011 to rally big.
Yeah.
And it touched a high of $1,920.94 on the 6th of September in 2011. But you know what it closed at that day? 1,872.
Oh, yeah.
So
big wick.
Yeah, it's not bad. Thanks for noticing. No, I'm just happy to see you, really. What can I say?
Is that a roll of quarters in your pocket?
Roll of quarters?
Is it a roll of pennies?
Is that a Louisville Slugger in your pocket?
Come on,
Ed.
Roll of pennies?
Roll of pennies. A roll of dimes. That would be the worst. Roll the dice. Anyways, we're getting off topic.
Are those TTC tokens in your pocket?
Yeah. Now this, my next guest here, I want you to, this is for Toronto people especially. So my new best friends, Roberto and Jacqueline Murata, own Ardo's just down the street here from our studio. And I went and visited them because they're about to open a restaurant near my neighborhood in Cabbagetown up on Carleton Street. So if you haven't been to Ardo and you want to see what the restaurant's going to taste like on Carleton Street, you can go to Ardo. And here now, without further ado,
you know what they should do? They should feature for their specialty Kapusta.
Kapusta.
You know what Kapusta is?
No, let's find out after this video, though.
Okay.
My next guest is Roberto Murata. He is the head chef and partner of Ardo Restaurant here in Toronto. Roberto, welcome.
Thank you. Nice. Thank you for having me here.
You bet. Roberto, how long has Ardo been in business?
It's going to be 4 years in May.
4 years.
Yeah.
So Ardo, if you don't know it, is on King Street in downtown Toronto, sort of towards Cabbagetown, and you're opening a second location in Cabbagetown.
We're going to shortly. We hope the end of February we'll be able to have things up and running.
Perfect. And you specialize in Italian cuisine. I've been to Ardo, so I know this firsthand. Tell me about how you got into the business and what's the philosophy governing your restaurants?
Well, this started a while ago when I was in Italy, specifically in Sicily, in the south of Italy, where I come from. I always gravitated around, the restaurant industry since I was 14, and you can imagine growing up in an Italian family, food was our daily, things to do it. So my passion, kind of a move on, and I had my own restaurant in Sicily, and I met my wife there. She's from Canada. She's from Toronto, and 10 years ago, I came here and I kind of start again from scratch, and here we are with the 4-year restaurant now, and another one on the way.
Sure. What like your pastas are all handmade, fresh daily?
All, let's say 80% of our dish are made in-house using a traditional ingredient. Some of the stuff we import directly from south of Italy. Some other stuff we try to source locally, in a very ethical way.
So how would you describe your most popular dishes?
How I'm going to describe? The kind of cuisine that we try to achieve there is very simple, based on a lot of history behind the dish, but also we give a little modern twist.
Okay, so what's the most popular dish?
The most popular dish is our octopus dish, I will say, because it's a combination. We combine the octopus with the sancaponata, which is a traditional vegetable kind of a side dish.
Okay.
With medley vegetable.
Sure. And is the new restaurant Dova going to be the same menu, or will it be very different?
Dova will have definitely a big portion of a Sicilian cuisine, but this time we'll try to get a little bit more some kind of a flexibility. So we're gonna get some inspiration from all the Mediterranean island that surround Sicily.
What's the kind of atmosphere that diners can expect at Dova, the new restaurant?
Dova's going to be a casual, nice restaurant to go. We will have a beautiful bar where people can sit and enjoy a cocktail before the actual dinner. We'll be able to provide a private dining room downstairs for a group up to 20. So
sure.
And we're also looking forward to open our patio, and the weather will.
Sure. That's a great patio back there, I remember. And you're probably going to do some lovely things with that terrace, I would assume.
Yet we invest a lot of time and energy on make sure the place will look like very unique. So
Toronto's a tough place to run a restaurant. In fact, having been in the restaurant business myself for a number of years, I'm a little bit mortified at how many of them come and go and how fast they come and go. Even really nice restaurants tend to disappear, usually in less than a year. So what is it about Ardo that has the staying power, and what is it generally about the restaurant industry in Toronto that makes it so hard to survive?
For Ardo per se, I think we are able to bring to the table something that is unique in a way, because we're focused on the Southern Italian cuisine, and we're very proud of what we bring. So there's a lot of quality and passion behind every single dish, and we try to have every single customer walk in to get a full experience, not just about the food.
Now tell me about the wines at Ardo. Is wine a major component of the offering for customers, or is the wine list something that's not the main event?
Well, the wine list at Ardo is very unique in a way, because let's say probably 60% of our wine come from Sicily.
Oh, okay.
So we specifically select, and this requires a lot of work, because we have a lot of different agents who bring wine, but not too many who bring Sicilian wine. So you're constantly searching for new wine coming from Sicily.
Yeah, that's it's interesting. I'm trying to think. Like I love Italian wines. I'm a huge fan of Amarones. I just bought a few cases of wines from a winery that specializes in Spana, which is Nebbiolo, only in this one province of Italy. I can't remember the whole story, but I'm always searching out different wines. And so the Sicilian wines are not very common in the liquor store or in restaurants, as far as I can remember.
Well, definitely they're not well known like a Barolo, but things are changing in the last, let's say, 10 years. For instance, up to the Etna, one of the main volcanoes in Europe that is located in Sicily, there's a big production on wine called Etna Rosso that is being considered the next Burgundy of Europe. So.
Oh, Etna Rosso.
Yeah.
I see. I'll have to try that.
That's something that we should try together. Definitely.
Yes, definitely. Will that be on the list at Dova?
Oh, we'll have a few of those. Yeah, we're selecting a few different Etna Rosso and Etna Bianco too.
Okay, great. Well, I really appreciate you coming in here and joining me today. We'll provide more coverage of the opening of Dova as it happens in February next month. Thank you very much for joining us.
Thank you.
If you're enjoying the show, subscribe to Midas Letter on YouTube so you stay up to date on everything investment. Hey, whoa! Just caught me by surprise there.
Yeah.
So, Ed, before we went away for the break, Ed brought up a very interesting word, and it was kapusta.
Kapusta.
And now, Ed, I'm going to give our assembled audience out there one chance to say what a kapusta is. And so, audience in the chat room, if you're listening, and there's now way more than there were, what I would like you to do is to enter into the chat dialogue. What is a kapusta?
What is kapusta?
What?
Not a kapusta.
See, you've just given it away.
No.
What is kapusta? Now everybody knows it's a food. Because you only referred to food without an article.
We're talking about a chef going to Cabbage Town, and I bring up kapusta. Duh.
Duh.
Like,
this show's
of
not
course-
about food.
Of course, it's food.
So now we're a food show.
And why it's relevant in Cabbage Town.
Interesting.
And you know the reason?
George, wait. We have an entrance
Does he
here.
have an Eastern European name?
George Home is his. Well,
Okay.
according to this, people don't often use their real name. Actually, it's spelt in the Latin American style, Jorge. But I don't know if George, are you Polish or are you Latin American?
Or maybe
His last name in the thing is
Hungarian,
Home.
or maybe
But
Ukrainian.
now you're telling me what kind of food it is, but I don't need you to tell me because Jorge just told me it's Polish food. It's a Polish dish.
Yeah, but what is it? It's
Whoa! Don't give it away now. Jesus Christ, Ed. We got to make this last for 9 minutes, so we go right to 4:30.
We're going to 4:30? When do we change it to 4:30?
You don't remember?
No.
See? You say poor old Bob Albione's
Oh,
losing
yeah.
his marbles.
Jeez, don't
Dementia.
say that.
Why? Oh, I said Bob.
You know, don't.
Right. That's right. Jorge is Portuguese.
Okay,
So maybe he's just a foodie who knows a thing or two about food. So
Suzanne, what's kapusta?
Pardon?
What's kapusta?
Like stewed cabbage?
Stewed cabbage?
Yeah.
Is that what it is?
Yeah.
How did you know?
Cabbage Town. Get it? Duh.
Cabbage Town, that's where I live. What's going on here? Oh my God, you know what? This show has to end, and it's going to end right now.